Hello and welcome to Nolan Financial Radio. My name is Chris McKinney from Nolan Financial Partners. If you'd like more information about what you hear during our show today, give us a call at 719-210-4242 or visit us online at our website, nolanfinancialpartners.com. And while at our website, click on the radio page, check out our past shows, and subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. When it comes to building risk is not unavoidable. It's essential. Without it, your money can't grow. But too much risk can derail your entire financial future. So the art lies in finding the balance. Identify where risk lives inside your financial strategy and take steps to manage it before it manages you. I like to use the word risk mitigation. I am a risk mitigation professional. So this is a year we've had soaring inflation, stubborn interest rates, volatile markets, global uncertainty. It's a good time to reassess your portfolio's risk because it's really important that you understand what those risks are. Today, we're breaking down 10 considerations that can help you approach risk with clarity and confidence. You can increase your chances of long-term success. Before we dive in, let me bring in my co-host, Tony Shore, who's been testing his own tolerance for risk by drinking gas station coffee every morning this week. It's not high stakes investing, but I'm not sure what's going on there.
Super scary, Chris. No way. I pass on gas station coffee. My dad was an over-the-road truck driver, and I used to go out with him. And man, that truck stop coffee used to be good back in the day, but I wouldn't do gas station coffee today. No, I'm kind of spoiled. I'm a Starbucks kind of guy, or even better, like a local coffee shop. But
So when we're driving our diesel truck, we stop at gas stations and we get gas station coffee when we're hauling the horses, doing that kind of thing, right?
Sure.
And so we've stopped like a Maverick or a Come and Go. Come and Go's, I guess, have sold out to Maverick. But they had they'd have 20 or 24 ounce coffees you could buy, and I'd get one of those and have that for the road. So then that just made it so we had to stop again a little early because of we had
bathroom breaks.
Download the coffee, but my daily driver's an EV, so I don't stop at gas stations. So I could use the drive-throughs at Starbucks, and then there's a Badass Coffee. Is
that the name of it?
Badass Coffee. It's out of Hawaii.
We're gonna we might have to censor that. I don't know.
So it's there's three locations here in Colorado Springs. For some weird reason, there's only like 6 of them in the world, and we have 3 of them. The others are in Hawaii. And but they have 10% Kona. You can get 100% Kona coffee.
Wow,
which is
awesome.
Amazing coffee.
Yeah, it's delicious. They grow it on the sides of the volcanoes, and it's the same with that's why Guatemalan coffee is so good. If you ever visit Guatemala, you have not drank coffee until you visit Guatemala. Go to the coffee plantation, right, and have a cup of coffee there of fresh roast beans that they just roasted. They roasted them, and hand you a cup of coffee. And it just like, if coffee tasted like that, I would drink it every day, all day long. I mean, it's so rich, nothing put in it, and it's creamy. It's like, how is this?
Oh yeah.
It's just delicious. So, and then I come back, I'll bring some beans back. It's not quite the same when I had it fresh roasted on the side. Literally, I'm in a building that's at the foot of a huge mountain that is a volcano where they harvest the beans.
Right.
And so it was that was fantastic. But yeah, we could talk coffee all day, but that Kona, that sounds great. Hey, but I have to go back to something in your intro. Now we're talking about managing financial risk, and I love the word you used, mitigation. And so I think you have a new title, Chris, Chief Mitigator.
Chief Mitigator. That's
the Mitigator. Chris McKinney, the Mitigator. Mitigator McKinney. Mitigator.
Yeah, that's me.
The McKinney Mitigator. Okay, no, Mitigator McKinney. That's what we'll go with. Yeah. I like that. The Mitigator. And I'm gonna put a little soundbite together with some echoes and effects and just huge voice. The Mitigator, Gator.
So the first thing people do is want to make money, right? Well, the last thing they want to do is start talking about risk tolerance, because
about risk and losing money. Yeah.
And about losing money. So risk tolerance is about losing money. And so that's the first risk we want to talk about, is how comfortable are you personally with the ups and downs of the market? Because right now the market is the number one place to turn, $100,000 into $200,000 over that 10 to 15 year time span, right? It is the best place. But can you take the risk? I don't know why people don't talk about it very much, but at the end of 2021 through the first 3 quarters of 2022, the equity market dropped 50%. It's one of the biggest downturns in our history, and nobody talks about it. So because it expanded, it was over 2 years. 2021 didn't see a loss in the market because it had such a good first 3 quarters. And then the growth funds lost like 27-30%. Bond funds lost 12%. So it was a really difficult market to have safe things. So that's what we talk about when we're talking about risk. The 2008 crash, the crash in 2022, that was actually bigger than the one in 2008 that nobody talks about. And then the whole 2000s is considered the Great Recession.
Yeah.
And so that is a huge risk that people had. I go back to 2001 when a Delta pilot I knew, he's a former military pilot, became a Delta pilot, was retired in 2001, and then he'd left all his money in Delta stock, and it lost half of its value that year. And so he had to go back to work. He had to go back to flying, but they weren't hiring.
So don't put all your eggs in one basket. The age old wisdom, and we always hear that.
That's right.
Age old saying, "Don't put all your eggs in one basket." I bet you've seen that a lot, though. If somebody works for a big company for a long time, and maybe they were offered stock options, I know in different parts of the country, it's different companies. I mean, I remember all those people who had worked at Kodak back in the day in Rochester, New York, where Kodak is based.
MCI.
And they had 100% of their retirement money and their savings in Kodak stock. And of course, the digital camera came along, and then of course phones completely wiped it out, but the digital camera wiped it out. Even bigger companies. I mean, you don't want to have all your eggs in one basket. And even companies that are big. I'm from Minnesota. 3M's a big company. It's a great company. At least it's been a big company, still is. But a lot of people used to have stock options, right? And so they would come into their financial advisor and have all their eggs in one basket. You don't want to do that in case something happens, right? And
that's right.
Something can happen, right? There's always black swan events, and companies have really, they could have a couple really down years, and then if that's where all your stock is at, you're going to really be in a bad situation.
You can be, but here's the thing about it is, The big problem is if your stomach can't watch your portfolio drop down during that market downturn and have some confidence that it's going to come back, it'll be okay, then there's that real risk, because you'll want to pull your money out of the market. You want to
You'll panic.
maybe make some rash decisions. I've had clients come in the office, new clients come in and said, I don't want to do anything in the market because they've had such a bad experience with those market downturns, and their decisions or their broker's decisions have pulled them out and so they buy high and sell low. And they've been doing it they did it like 3 or 4 times, and they just can't take it anymore. So we consider the risk tolerance very low. So we make sure that their money is in places that are safe.
Yeah.
So that's what risk tolerance is. Can you withstand the dips and wait for the market to come back without making emotional decisions?
And everybody's has their own personal risk tolerance, and it's going to be less about numbers on a spreadsheet and more,
right?
Can I sleep at night if my account dips? And I've seen this happen with friends. I mean, it happened I've seen this happen with people in April of this year, in 2025, April, when tariffs were first announced. The market dipped almost 20%. Some
Right.
aspects of the market dipped quite a bit, 10 to 20%. And some people they're like, oh, tariffs, we're headed into a really bad time. I'm going to pull my money. And had they stayed in, it went right back up in May.
Yeah.
I mean, it was a month later, and it was already hitting record highs. So not only would they have been better off to stay in, they would have really done exceptionally well. They not only would have been okay, they would have done great, because since then the market's hit record highs.
The third quarter returns are great right now. So
yeah, so far so good. I mean, even if we had a downturn or a correction, the market would still end up probably for the year. So
probably will end up.
Yeah, and so you've got to look at your time horizon and be in it for the long haul. Otherwise, you're going to end up selling high and buying low. Right. So you can't let your emotions be involved. And that's what risk tolerance is all about, isn't it?
That's what it's all about, is understanding that my money that is at risk has this amount of risk, and it's going to go down, and I've got to wait it out if it's something that's in the market, or if I can't take that, find an investment that doesn't contain that risk. Right. So it's not just being able to take the risk. It's like, okay, I can't take that risk. What can we do to mitigate that risk? Can we offset the market risk? What can we do about that? Can we move into a managed fund that pulls off money into cash and gold, utilities, things like that, when the market is on its way down? So there are ways to manage it by managing the money in the market. There's ways to manage it by having alternate assets.
Yeah. Yeah, there you go. And I think that's really good. So there are things you can do. I mean, the main way somebody can avoid to figure out the main way they can figure out their risk tolerance, our listeners, figure out their risk tolerance and avoid excessive risk, but yet have growth, is to work with a trusted fiduciary, a financial advisor who's going to look out for their best interests.
That's
not
right.
Just try to sell them products, but just looking at their overall picture and saying, hey, what's going to work best for you? And looking at all the options available. And that's what you do, right?
That's right. That's what we do, is we make sure that they're aware of their different retirement type of tools that are available to them, whether it be buy and hold strategies may be better for them. Maybe an active money manager may be right for them. Maybe doing a stockbroker. Maybe it's a do-it-yourself, right? So maybe we can help them create a do-it-yourself kind of account and make sure that we manage the taxes in it. Because the biggest problem most of the actively managed or do-it-yourself accounts is trying to manage taxes. So taxes come to play because we have a tax risk associated with investments, and we want to know what those are, and then how do we best mitigate that. So there's ways to do that. If you have big tax bills because of your investing at the end of the year, you're not going to be very happy either. So that's a big mitigator for us.
Taxes always play a part.
So,
they always play a part, and you've got to take that into account. But you have, before we move on, I know you have a risk tolerance, basically a questionnaire to figure out people's risk tolerance. How can our listeners get that and set up a consultation with you to see where they're at as far as personal risk tolerance? And then you can look at where they're at, look at their accounts, their 401ks, IRAs, their investments, and say, okay, here's the level of risk you're at. Here's your personal risk tolerance. And here's how we might suggest balancing it out a bit more or getting them more in line with each other, right?
That's right. So we have that. They can reach us at 719-210-4242. We'll set up a complimentary consultation for that. We usually do those Tuesdays, Wednesdays, and Thursdays. We'll accommodate people in the early evening so that if they're having to work, they don't have to take time off their work, or we'll meet you at lunchtime, whatever works best for you. Give us a call at 719-210-4242. Check out our website, nolanfinancialpartners.com. You can learn more about us and listen to some of our past radio shows.
Awesome. Hey, that sounds great. So today we're talking about managing your financial risk, or mitigating that risk. I love that. And I'm here with Chief Mitigator, I love it. Chris McKinney, Chief Mitigator. Yep, Chief Mitigator. So you've got people, some people might feel comfortable taking big risks, but maybe their situation isn't right. So you might think, I'm fine with risks. I know the market goes up and down. Well, are you in a situation, though, to take those risks? You probably still need some balance. Some people, I think it's more, it's the difference between I want to bet big versus should I really be betting big with the money I have, or am I going to need that? Right.
Right. What are we doing? So that kind of leads us to risk capacity. So when you have a tolerance for risk, okay, but capacity is what risk can you afford? So, and that's based on your own time horizon, for how long you're working, those kind of things, when you're going to start spending the money, right? Because risk is different for somebody in retirement than somebody who's still working. So risk capacity plays into, a big part of that is, are you working or not? And then what are all your resources? If you have a large amount of resources, you can afford more capacity for risk because you can recover. You have time to recover because you have enough funds to wait out those market changes.
Yeah, there you go. And so, your time horizon really factors in to managing risk, doesn't it? I mean, that's one of the main, really, besides your personal risk tolerance, once you figure that out, you've got to look at the time horizon. Isn't that what you look at when people first come in to help them mitigate risk? Like if I'm going to need $50,000 next year, you're not going to have all 50. It depends on, or that I'm not, if maybe I have health issues and I'm already 65 or 70, you're probably going to not have everything I have in risk. Yeah.
Right. Because you want to have it, you want to be able to spend it next month. Spend it next month. If you're trying to spend something next month, why would you have it at risk? And if we saw like the beginning part of 2025, we saw the market going wildly up and down, and then you're selling in a down market. that's capitalizing on your risk.
Right.
And you lose your own capital because of that risk when you sell in a low market. And so that's what we're trying to avoid. That's the big risk we're trying to address today. So you want to have your funds aligned with how you're going to start using them. If you're not using them, then you need to have them aligned with what your time horizon when you are going to start using them. So retirees sometimes overreach when they try to recover losses. So that can be a problem in retirement. I lost this money. I got to go be more aggressive with it. Well, maybe not. So we got to look at all those kinds of things and make sure everything is aligned with your financial needs going through your retirement system, going through your retirement, and then how the systems you have for retirement are going to play into those factors.
Yeah, I can see that. And so obviously there's a lot to it, and that's why people need to be working with someone like yourself. So what else do you want to cover when it comes to managing someone's risk?
So we want to manage people's reactions. We want to have cash cushions. We want to avoid any panic selling. We want to have a plan that provides flexibility when the market goes down, that there's a place that we can go to pull money from that is out of the risk profile that the money that went down is in. So they're not even associated. So when people talk about, asset allocation is not, okay, I have GE stock and Coca-Cola stock. So there's my asset allocation. So if one's down, maybe probably the other one won't be down, right? So they'll probably both be down at the same time because that's how the market kind of goes. It's supply money and then people wanting to get those stocks. And so that's how stocks are valued. And so if the supply of money leaves the market, then the values of everything in the market goes down. So asset allocation is it's good to have different stocks. I'm not saying that. I'm saying there's good to have something that's not related to the stocks where some of your money is.
Yeah.
So,
and there are other options too. I mean, you have so many options, even within the market. If you still want to be in the market,
you can.
There's buffered index portfolios where you get downside protection. There are other tools where your principal's protected, and then you take on less risk. But you also need that growth that the market provides. So you've got some long-term money and growth that, hey, if the market's down next year, it's okay. I've got this over here I can use for income and to pay bills. Well, until that comes back up.
Right.
That's the kind of balance we're talking about here, isn't it?
That's what we're talking about, is having a balance so that we're not taking that full on drop of the market. When the equity market goes down 50%, how are we mitigating that? So, typically if we can't half the market drop, then we're not doing a good job with our management. That's kind of the way we look at it. So if there's a 50% drop, our clients should not have that. So we want to stay away from that. We don't like it at all. So what are we doing to do that? And so we have some classes of funds that are more managed than others so that we don't have those big drops.
Yeah, that's great. And I know that you've helped so many people with this over the years, Chris, and you and Tara, and that's what you do at Nolan Financial. People, it's human nature to be emotional.
Yeah.
And that's why all the statistics show if you're not working with a trusted financial professional who's a fiduciary, if you're trying to do it on your own or just working with a broker, things tend to end up you end up buying high, selling low. You don't want to do that. It's the opposite. Because people, when they see the market going down, they tend to want to sell, or they see a drastic drop. If they see a real success story, they want to jump in. It's like jumping in on something after by the time you hear about it, if it's something that's exploded, it's too late to make money on it, at least in the short term. So that's why timing the market usually doesn't work out, right?
No, it doesn't work out. Timing in the market is because you just never really know. And this year is a big case in point. The market's timing was based on news cycles. And so the news cycles would drop the market. And something else came out in the news and it would drop the market. It had nothing to do with the actual companies that you're buying the stock of. It had to do with the way people felt generally because of news. So I don't know how you mitigate that kind of, news risk in the market is real. And so there's no way to mitigate that other than not being in the market or using portfolios that kind of manage that. So there's a lot of other risks we haven't gotten into because there's inflation risk, there's risk of taxes, there's deflation risk as well. There's concentration, that's over exposure. We kind of mentioned that. But overexposure risk can also apply to sector and asset classes. So if there's, something, what happens if oil, we don't need oil for energy ever again?
Yeah.
What happens to all your oil stocks? Or what happens
Yikes.
if something like, you can just look at a commodity like silver. Silver's a commodity because it's used in stuff. And look at how it goes up and down. Look how gold goes up and down. All these things have risk associated with them, and you need to understand what kind of asset class that these are falling in, how they're going to respond to the market, how they're going to respond when the Fed changes interest rates. So we have interest rate risk, right? How does interest rate risk affect your portfolio? How does it affect your personal finances? If you have loans out, maybe you have loans that are attached to prime, and so does that change? How your daily amount of money that's going out if the prime shoots up. So a lot of these things we don't want to. We don't want to turn a blind eye to them. We want to know what the risks are, and have a plan for them.
Yeah, that's true. Well, we're almost out of time too, Chris.
Oh boy.
It's just, it's flown by. A lot of great information, but managing risk is one of the most important factors to having a successful financial plan and, of course, retirement eventually.
That's right.
And it's just such a big part of the plan. It's basically where you begin, right? I mean, you look at where they're at, the time horizon, and then figure out how to balance things to manage that risk. So if our listeners want to do that, if they have questions, how can they get a hold of you?
Listeners can visit our website at nolanfinancialpartners.com, or they can call our office at 719-210-4242. We'll discuss how we can answer your questions, address your concerns about managing financial risk, your financial strategy, or any other parts of your retirement. It's our goal to help you prepare for the retirement you've worked so hard for. Give us a call, 719-210-4242.
All right. Sounds good. Thanks, Chris. And hey, say hi to Tara for all of us. We'd love to see her on the show again. I know she's been really busy, and
Yes.
You guys are busy talking to everybody there. But that does it for today's episode of Nolan Financial Radio with our host, Chris McKinney, the Mitigator.
Join us again soon for another episode of Nolan Financial Radio. Take care, and we'll talk to you again.